Hi and welcome, James here from Impact, and welcome to our monthly update. It's been some time since I've done a monthly update, but I think this one's a timely one. All the noise in the media, where the housing market's moving to, we know it's softened. Inflation, interest rates, the cost of all goods and services all going through the roof. We're noticing also the building industry. So there's just a lot of noise. I'm going to try and unpack what it means. I'm going to talk to you around the roles of the central banks, because they have a big influence on asset pricing, and they're the ones that are making the decisions to lift interest rates. I'm going to uncover the reasons why to give you guys an understanding. This is not about me telling you about the properties that we've listed and sold. The market's still good. Yes, we know it's not as strong as it was at the back end of last year. Things are still moving. People still need to buy and sell houses. It's not all doom and gloom, but I'm here to unpack a few things to educate you guys, and just a couple of things I think personal households probably need to prepare, because I expect the interest rates to continue to move higher. So let's get stuck into it. There's a lot of noise in the media about interest rates, inflation. Now I want to teach you around central banks and their role. Central banks, I'm talking about the Reserve Bank of Australia here and the Federal Reserve in America. We have to look at what America's doing, and that's the economy that I track quite heavily. So the central banks, their two primary jobs: to keep unemployment, have a low unemployment rate. Anything below 5% is great. That's number one job. The second job is the inflation rate. They want it at 2%, maximum 3%. So they've got two jobs to really look at, to try and have a strong or a low unemployment number and try and keep inflation below that 2%. Now let's dial back to when COVID hit. When the economy is contracting back, it's the central bank's role to try and stimulate. The fear of recession, the fear of unemployment going up, of inflation going below 2%, they need to find a way to stimulate the economy. Now central banks, what they do, they print money. That's what people know. They print money by buying bonds. I won't even talk to you around the bonds and how that works. But I want to take you back through 2020 when COVID hit. And it's the same that applied in the GFC. When the economy came backwards, they put a lot of money into the system. So let's have a look at the unemployment rate when COVID hit. You can see here, we're tracking below 4%. Now in America, it went up to 15% very quickly. We saw the economy stop, businesses laid off staff. The jobless claims in America went through the roof. We saw the share markets tumble down in that sort of first two to 3 months. It was at that point where the central banks needed to make a decision. Do they just let the recession continue or do something about it? Now, government's job is to always make sure they're there to support in bad times. They treat them like the buyer of last resort. So they decided to print more money than what we've ever seen before. Now have a look at the unemployment rate. Since they put the bazooka in the economy in terms of printing money, you can see the unemployment rate has now dropped in America below 4%, which is great. I think everyone I talk to, whether you're a business owner, people are finding it hard to find good skilled people, and we're seeing wage costs going up as well. So when you look at the central banks, then one of their targets is to have a low unemployment rate. So this is a big tick. Whether it's the Fed in America, we've got a strong unemployment rate here in Australia. Let's have a look in Australia. You can see here, unemployment rate pre-COVID was sitting around 5%. It motored above 7%, and since the money printing came in and the governments or central banks did what they needed to do, we've seen our unemployment rate also drop to 4%. Again, that's a big tick from the central banks. This is what's led to inflation. They can talk about, there's no doubt the war in Russia, Ukraine has led to energy prices going up. but you can't expand your balance sheet and more than double the amount of money in the system without some inflation pressures. So this is the Fed balance sheet. If you have a look pre-COVID, 4.1 trillion. When COVID hit and the fear of the recession, you saw the unemployment number skyrocket. That's when the central banks came in and did whatever they needed to do to avoid that recession. It happened very similar with the GFC, but not to the extent of the GFC. We've never seen this amount of money printing in our lifetime. 4.1 trillion up to almost 9 trillion. You're talking more than double of the money in the system. Now that money's got to find a place. And what actually happens, people, whether it's businesses, money hits the pockets, people spend. The demand for things just go through the roof. This is what is causing the inflation problems today. So big tick to the central banks. They've got a very low unemployment rate. We all know it. Everyone's finding it difficult to find good skilled people. We know wage pressures are going up. Now the second job of the central banks is the inflation number. Now this is a big one because this moves on to the decision of central banks and why interest rates are moving up. So let's have a look at in America. So you can see here, they like to try and keep it. This is a 10-year chart. They like to try and keep it around the 2%. If it hits 3, they try and pull it back. Now when COVID hit, inflation went dramatically down. Unemployment rate moved up, inflation went down. That's where they did everything possible to avoid that long-term recession. And if they didn't do anything, it probably would have led to potentially a depression. But the amount of money, you're talking $4.5 to $5 trillion in the system. That's just in America. You think of what we did, over in Europe, over in UK, all the central banks have got the same playbook. Now let's have a look at inflation. When I became concerned on the inflation number was around mid last year, 2021. In January 2021 in America, the inflation number was 1.4%. It moved above the 3%. It hit over 4% in April 2021. And at that point, they should have done something, but they didn't. They just continued through. Then it motored all the way into the 5s. November last year, it hit above 7. That was a time to suggest they needed to step in, they needed to stop printing money, and they needed to start lifting rates, but they didn't. They basically said, well, Jeremy Powell, the head chairman of the Fed Reserve, he said that inflation's transitory, and what he meant by there was that inflation was a short-term problem, it's just going to go away. But it hasn't gone away, and inflation number is continued and continued. So in America, you're talking 8.6, the last reading, inflation. That's well above the 2%. So you can see they're in a bit of a bind. Now let's talk the Australian market. If you have a look at the inflation number in Australia, again, we report quarterly, America, UK, they report monthly. COVID hit, you can see how the inflation number right across here sort of maintains at that 2% level. COVID hit, went down. And now the last reading was 5.1%, and our next quarterly reading is going to come out shortly, and that's definitely going to be more than the 5.1. You look at the UK, they're at 9%, America 8.6, our last reading in March, 5.1. So we're definitely heading higher. So this is the dilemma. This is the problem the central banks are here to solve. They've got a low unemployment number, but this inflation number is the very reason why the cash rates are moving up and why they will continue to move up over the course of this year. They need to try and bring this inflation number back to that 2 to 3%. Let's have a look at the consumer in terms of their ability to borrow. In America, in September last year, the 30-year fixed mortgage rate was 2.99%. Today, it's 5.81. So in the space of 9 months, an American goes and buys a home, they could get just under 3%. Today, it's just under 6, pretty much almost double. In Australia, the variable rate loan back in October was 2.3%. That's now gone to 2.9%, and that's going to continue to move higher as the RBA has no other option but to lift rates to try and pull our inflation number down. The 2-year fixed rate in Australia, this is the one where I think our interest rates will move to, and possibly a little bit higher. If you were a buyer and bought a property back in October last year, you could get a fixed rate for 2 years at 1.9%. Today, if you buy that same property and you wanted to fix your interest rate for 2 years, you're paying 4.6%, more than double interest rate. So you can see that the interest rates are definitely going to continue to move higher. But even though they say the 2-year fix goes from 2% to 4.6%, more than double, it doesn't necessarily mean that your repayment doubles. So if you've got $1 million mortgage and you're paying, say, $4,000 a month, it's not like it goes to 8%, but it will go up by about 40 to 50%. So that $4,000 repayment could go up to around 6%. So this is where you really need to start preparing, looking at your own personal cash flow to see if you can support that buffer. So that's where I just wanted to make sure, in terms of educating, you've got to look at your personal cash flow position to see if that can be supported. The second thing when it comes to the lift in interest rates is the ability for people to borrow comes down. So you can see how when the economy contracts or the ability to borrow comes down, it has to have a natural effect here in the real estate, and it's no different to any other asset class. So I had an interesting case scenario. Let's go back to a live case scenario. I had a buyer that has been looking for 9 to 12 months, and they were very interested in one of my properties, and they could borrow up to 2. So they were looking at around that, north of 2 level. Now, because the 90-day pre-approval had lapsed, they were interested in this property, went back to their broker, and they could only get up to 1.8. Now that was after the first lift in interest when the RBA recently announced. So you can see the ability for people to borrow will come down. Now, unfortunately, they couldn't borrow that. They couldn't buy that property because their ability to borrow came down. So this is just something that will naturally, bring prices down a little bit. Let's have a look at the implications on the share market. There are always a good indicator as to what typically happens in real estate. You look at the ASX, we peaked at the start of this year at 75.65. We're now at 6692, so we're down 11.5%. It's had a bit of a bounce over the last few days. The Dow Jones, which tracks the top 30 companies in America, they're down just under 15%. The NASDAQ, you think Google, Amazon, all the big leading tech companies, down 26.7. We've entered the bear market. Bitcoin, so anyone trading Bitcoin, I was telling people to jump out of Bitcoin. Bitcoin in terms of Aussie dollar, 87,000, now down to 30. That's basically 65%. So all that speculation into crypto and all these shares, when money's cheap, that's no problem to play in that. But when the central banks contract and reduce money and make borrowing costs go up, all of a sudden the appetite to speculate is not there. So we're seeing that rotate. Now, in terms of the local real estate market, our data, we normally apply a 6-month moving average on our median prices. So we're basically grabbing the last 6 months median prices divided by 6 to report our 6-month moving average in terms of median home price. But that's a bit of a lagging effect. What happens in 6 months to where we are today is completely different. Let's just look at the monthly median home price. Mount Eliza, and I could feel it. Obviously, we sell the most through the Mount Eliza, Frankston South Corridor. Through our group, 45% drop in buy activity numbers. We could see it on the field. The median home price in Mount Eliza was 1.88 in December. At the end of May, 1.73. Now, that's a change of 150,000 or down 8%. Now, people might think that's the end of the world, and I'm going to talk about what it means to vendors and buyers. I still look at it and say, let's have a look at October 2020. That first major lockdown when we bounced out and we had all the flood of buyers coming down to us. the median price was 1,275. Yeah, it went up to 1.88, we're now down to 173, but we are still 36% in front from October 2020. Now that's not the end of the world, right? Now let's have a look at Frankston South. Frankston South, it's actually come off quite a bit. November 21 had a median price over 1.3, May 963,000. That's actually a big sharp decline, 26.5%. So that's looking at the 2 monthly medians from the peak to now. But again, before COVID, October 2020, Frankston South's median price was 862,000. So we're still 12% in front. I'll grab another, say Mornington, 11.9% from the top, Mount Martha, 19.8, Seaford, 4.8, Langwarrin, 16.2, Jumana, minus 10.1. So you can see the market's already been felt here. But in saying that, we're still well and truly in front from where we were back in October 2020. Now, a lot of people will say, James, and you're dealing with buyers and we can, find a cheaper alternative in 3 to 6 months. I'm going to talk you through what it means to you as a vendor if you're potentially looking to sell, and also some of the conversations we're having with buyers as well. But we know the market started to pull back. We're already seeing the signs of it. It's not the end of the world. I've personally sold just as many properties in this first 6 months than what I did in the last 6 months. But what's becoming more important, you have to get pricing right. We're in a highly price sensitive market right now. So if you're a vendor looking to sell, you have to get it done right. You cannot hit the market at a level where the buyers aren't going to see the value. You have to be smarter. If in fact you sit on the market and the market comes down, it will actually cost you more. So we're in a price sensitive market. Are buyers still buying? 100% they're still buying. And there's some certain scripts we're actually working with buyers in around that. So I'm going to talk you through that as well from a vendor and a buyer's perspective. All right, so I've got a couple of notes I'm just going to make reference to, but let's talk through the vendors and we're going to get this up on the screen. Some of the conversations I'm having with vendors is I'm never here to guarantee a certain price. I'm not going to entice my vendors or tell them what they want to hear just to secure their listing and then drop them down in price. It's just something, it's not a price maximising strategy. I think you will get your best response in the first 2 to 4 weeks. Getting the job done in the first 2 to 4 weeks becomes very important, because the longer we sit on the market and we're seeing the market going down, it's not going to be in your best interest. Anyway, the first thing is most agents or some vendors will look at price in 3 to 6 months. When it comes to pricing properties, an agent will come out and look at 2 or 3 comparable sales as to what's sold in the last 3 to 6 months. Well, the market's changed. Well, I could see look at Mount Eliza, 188 in December, now 1.73. So what sold back last year, it's completely different to where it is today. So that's one that you need to really focus on. The second thing is, you buy and sell in the same marketplace. Yes, you may have missed the peak, but that vendor that sold in November, December last year, guess what? They might have got a record price, but when they're buying, they're paid a record price. Who can time the absolute bottom and the top of the market? It's a very important message. When you're buying and selling in the same marketplace, does it really matter? It's try not to get caught on what sold 3 to 6, 8 months, street records everywhere. We've all did it. Every single agent got records over the last 18 months. You've missed a boat, but you're buying and selling in the same market. Yes, you're going to compromise and get a little bit less for the sale of your property, but when you turn yourself into a buyer, geez, you're going to have less competition and you're going to buy at a cheaper rate anyway. Actually, vendors looking to upgrade, it's actually in your best interest to do so today, because 8 to 10% down on $2 million versus $1 million, it's going to be in your advantage if you are looking to upgrade. The last point I want to mention is whether an agent tries to lure you in a certain price, sign you up for 4 months. It's a common tactic. Actually, the best real estate trainers in Australia actually tell that tactic. Yeah, it's pointless. I think you've got to move away from price and focus on the process. The market will determine where your property sits. But we had a couple of examples, actually 4, and these are fresh on my mind. You know, one particular example I appraised at 185 to 2. They generally felt 2.5. Came on with another agent at 2.3 to 2.5. This was at the start of the year. They're still sitting on the market, 5 months later? And there's another one, similar case scenario. So all I can say, whether you're a vendor watching this, and even agents watching this, you know, I think we all got to steer away from price. The market's going to determine value. We can give you an estimate as to where we would expect market to see value without not putting or capping or putting a ceiling as to what your property's worth. But to overpromise, underdeliver, certainly something you're not going to get from us and any of our agents at Impact. So just be mindful of that, and also vendors who think their property's worth a lot more based on what's sold in the last 6 months. Just remember, you're buying and selling in the same market. So hopefully that's some useful tools for the vendors. So let's move on to the buyers. The fear of missing out, it is not there. You know, it's definitely been a seller's market for the last 18 months since COVID hit. It's now shifted back into the hands of the buyers. You know what, the market's actually normalised. It's gone from nuts to normal. And it's actually quite a good thing. We couldn't continue to run at that pace. All right, so buyers' reluctance to move forward. Here's a couple of things. James, I expect we could pick up a property cheaper in the next 4 to 6 months. When interest rates? We can hear on the media, it's played everywhere, social media, the main media outlets, in the papers about the housing market. Well, we're already down. We're actually encouraging buyers to say, well, look, you're buying and selling in the same market, so that doesn't matter. It's no different to, you know, talking the response back to vendors. The second thing with buyers is, can you see yourself living in this home for the next 10, 15 years? Very powerful question. If you like what you see, every house is different, especially in the market. Mount Eliza, Frankston South, every home is different. If you like something, have the confidence to move forward. I mean, 6 months ago, you would have been competing up against 6 to 7 offers. What would you prefer? Compete against yourself or another 6 or 7? So I think, you know, some important conversations to have with buyers in terms of getting them committed. Another thing is too, all the properties that we've bought on and sold, which we have, we've already had the pricing conversations with vendors. So, you know, 6 months ago, I've appraised properties 6 months ago at 1.9 to 2, and we had to have those difficult conversations. So just educating the buyers in this marketplace becomes even more important. But if you're a buyer, what would you prefer? Competing up against 6 to 7 offers, or you've got an opportunity to secure the right property for you and your family? That moves on to competition's less. I've just mentioned that 6 months ago, buyers, 30, 50 groups through at opens, multiple offers. It was a lot of buyers. It was hard to see people miss out. Today, you've got choice, you've got time. The market's already softened. It's a good opportunity to buy at 8 to 12% less than where we were 6 months ago. Again, if you've just sold, you're buying and selling in the same market. The other one, this is a big one for the buyers. Don't be caught out. If you've sold and you want to wait 6 to 12 months, your ability to borrow is going to reset every single month. The RBA moves interest rates higher. So what I mean by that, interest rates will continue to move higher. Your ability to borrow is going to actually come down. Now, what you need to do is stress test yourself at 5 to 6% to make sure you can afford it. If you can, make the move, because if you're just recently sold and you're looking at 6 to 12 months, you just may not be able to borrow what you're looking to and getting into the area that you're wanting for you and your family. So a couple of important messages to the buyers. Don't be reluctant to move forward. If you see the house, look at this for the 10, 15 year proposition. It's a good time to buy. You're up against less competition. And the third big one is just be mindful if you've sold, and as interest rates continue to move forward, your ability to borrow will come down. So you may not be able to afford that property in the marketplace. So hopefully that sort of gives you an indication, some important messages to vendors, to buyers. I know this is a lengthy video in terms of educating about the role of the central banks, why interest rates are moving, but it's the inflation number that's a big concern, and that is the reason why interest rates will continue to move higher. People will always ask me, James, what do you expect to happen in the next 6 to 12 months? No one's got a crystal ball. I think the next 6 months we're going to see interest rates continue to move higher. There's no two ways about it. I think inflation's a big one. We need to see that inflation number down, and hopefully we can see that start rolling back later this year. I think the central banks are going to sacrifice unemployment, so they'll bring this economy back with it. We've got a strong unemployment number, so if businesses earn less, therefore unemployment, people may start getting laid off. So I think that will happen. But like anything, that inflation number, once they get that inflation number to the level they want, the central banks will just flip and do a U-turn. And guess what? When the economy gets to a halt and they've solved the inflation problem, you watch the central banks lower rates and put more money in the system. So look, things happen in cycles. We're in a changing cycle. It's not the end of the world. People buy and sell all the time. Just stress test yourself financially. You know, if you an extra 3%, 3 to 4% on your current levels. We know food, energy, and all our staples are going up. So just make sure you're factoring into that on your cash flow. But hopefully this gives you an indication where things are at. And just I felt it was important just to explain the dynamics, because there is a lot of noise in the media. And hopefully this breakdown sort of unpacked, as to the reasons why. Our agents, I train our agents once a week. They've been fully educated since January. We don't just talk about, real estate pricing, marketing, just the basic fundamentals of real estate. We do train this. We are here to educate our clients to make better decisions. So anyone looking to sell on the peninsula, feel free to give any of our officers a call. Our agents are educated in this. So hopefully this video was useful. If you want to make a comment, if you disagree with what I'm saying, if you agree, love to hear your thoughts. Again, if you're in that Mount Eliza, Frankston South, if you need any advice, my details on the screen. So appreciate your time. I will be doing this on a monthly basis. I'm going to continue to track the data and keep everyone informed.